India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Well, 25,000 touch and miss, not quite touch, but almost there and miss. That was the story yesterday. Will we be able to claw our way back up once again? Not very far away from where we left off in trade. This is, of course, a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Nigel and Sonia. Guys, good morning.
Hi, good morning, Prashant. Good morning, Nigel. It's called what? Fear of heights, right? Generally, when the markets touch all-time highs and then they come back from there. This morning as well, Asian markets are not looking that great, but let's see. Ours has perpetually been a buy on dips market, so let's see how it goes.
Maybe the equity markets want to wait by to hear from the central bankers. We have the Japanese central bank that will be speaking a bit from now, and also maybe hearing in from what the Fed has to do and what they have to say with regard to the September potential rate cut. So maybe wait and watch till the central bank action gets out of the way.
A lot of action. Actually, last night was the only day, I think, this week where there was no action.
Yeah.
Because next 3 or 4 days, it's full of action. Earnings. Central banks, as you said, and of course, some economic data with the jobs number. So let's sort of rewind the clock back, tell you what happened and where we left off yesterday. So not a bad picture. Broader markets did well. The Nifty ended flat. The Bank Nifty also flattened out. Banks, of course, have been the weaker indices. Bank Nifty ended down last week as well. One of the few indices which ended the last week down. So, you know, it's been sort of struggling a bit as compared to what the Nifty's been doing. So we came within, I mean, I think the high was 24,999 point something, right? That was the high. So practically for all purposes, you're there. I mean, but you can't print it till you actually hit it, right? So we'll see. So that acted as a bit of a psychological resistance more than anything else. US equity markets ended flat. This is, of course, last night ahead of a wave of catalysts, as I said, which the market will look forward to. The Nasdaq was almost unchanged. The 10-year lost about 2 basis points. The bond yield, that is, dollar index went up about 0.2%. We're at about, what, 104.5. Oil prices, they continue to drop. So there was another 1.5% drop, and now you are under $80 on Brent. In the last 1 month, oil prices have fallen almost 8%. So that is quite a significant fall in a short time span. Now, of course, at the margin, people are talking about what's going to happen in the Middle East, Israel, Lebanon, etc. But, I mean, you're coming into all of this with a sharp drop in oil prices. Now, the big catalyst this week, FOMC, this is on Wednesday, and the June jobs data on Friday. I think these are the two big ones from a global market perspective. And, of course, you also have numbers from the remainder of the so-called Magnificent Seven companies. Microsoft, Meta, Apple, Amazon, all of them will report. And, I mean, you know, more than data and more than policy decisions, because, you know, so much of what the U.S. market has done has been driven by these large mega-cap stocks. Earnings and the direction ahead becomes important. You know, I'll just sort of quickly come back to the levels here. So, once again, for the Nifty, the supports become the averages. Because the 20-day is very far away, about 400 points away from where we left off yesterday. You look at the hourly average, and that comes in at 24,625. That's about 200 points away from where we left off yesterday, because the pickup in the rally has been so sharp, especially last Friday. Even there is a bit of a gap. But, I mean, that's the closest that you could sort of work with as a support level. So 24,625, and then the 20, which is 24,454. On the way up, broadly, I mean, the targets remain 25,000 to 25,337. These are extension levels on the upside. Bank Nifty, it faced selling pressure around the, I mean, basically the 61.8% retracement and the 20-day moving average almost coincided. You know, at the high point, the Bank Nifty crossed both these levels, and then, of course, from there was a very sharp sell-off. So on the way down, the low of 50,438 becomes the important level which the Bank Nifty must hold if the up move has to sustain, even after breaks, etc. And the Nifty Bank needs to take out yesterday's high, which is 52,340. As I said, that coincides with some moving averages like the 20-day, etc. For you know, further up move and further strength to really show up. I mean, you know, lots of catalysts ahead, not very much last night. Earnings remain an important picture, and I will repeat what I said yesterday. Unlike what we've had till last week, you know, you're starting to see surprises on the upside as well. So, NTPC is an example. Colgate is another example this morning. So at least you're getting beats. These are not big stocks which will move the index one way or the other because they've got large weight. But these are important markers for their respective sectors. So it's not such a bad thing. The opening is suggesting about a 70-odd point lower start. Sonia.
Absolutely. And, I guess this fear of heights is something that you can expect, right? Because of the kind of moves that we've seen in the last many days. So this morning as well looks like it's going to be a slightly red start because across the board, whether it is the Asian markets, a lot of Asian markets are under pressure as well. Yesterday, our own market had a bit of a, tough start to trade, tough end to trade rather. The Nifty fell about 160 points from record highs yesterday. However, if you look at the flows, right, the buying from domestic institutions continues. So there was large buying, almost 5,700 crores of buying from DIIs. However, the selling from FIs is something that is a bit disconcerting. But we're still at record highs and there's no need to be concerned. Little bit of come off is, I think, par for the course. Some stocks that I'm looking at, consumption stocks definitely will continue to be in focus. This morning, as Prashant was also pointing out, Colgate could be the big one to look at. 13% revenue growth, high single-digit volume growth in the toothpaste segment. So this is something that I have a close eye on. Apart from that, ACC as well, strong volume growth. 9% volume growth year on year is what ACC has seen. The numbers beat estimates on that front. So, I'm looking at that stock as well. And auto stocks will be in focus. There's so much action over the next couple of days. There are Maruti and M&M's earnings tomorrow. Of course, you have the Ola IPO that opens on Friday. And then you have the auto sales numbers as well. So we have an action-packed next couple of days in the auto sector. Lots to track. And we'll get you up to speed on all of that. But just purely for today, there are several things to watch out for. There's the US two-day Fed meeting that begins today. There are a lot of big tech earnings that come out in the US as well, whether it's Amazon, PayPal, etc. So our eyes will be on that.
Well, that's right. It continues to remain a buy on dips market. And if you look at the FIs, what they did in yesterday's trading session, they unwound some longs as well as they covered some short positions. So the short positioning went down by close to around 20,000 contracts. They remain net long, but close to around 65% of their positions on the long side. If you look at it in absolute terms, well, at the start of the series, the net long positions from the FIs were roughly around 60,000 contracts. Now, in the last few sessions, that as well has moved up. And as of current reckoning, but it's holding at around 1.5 lakh contracts. So not overtly net long. In the last series, remember, we saw numbers of closer to around 4 lakh contracts as well on the net long side. So it's at around that 1.5 par for the course, I would say. The client positioning, well, they had moved into the net short positions. And now, in fact, the short positioning is at around that 46,000 contracts. That's on the short side. And, that's the long contracts in terms of lakh contracts that we're looking at. So both of them on opposite ends of the spectrum, but not at extreme levels. So that's how they are positioned. Let's give a word on all three indices now today. Today, the Nifty Financial Services Index, that will play out the weekly expiry. Yesterday, it ended as flat as can be. Today, it could be a move up, particularly in the second half of trade. Then on the Nifty, going by the options data, the 25,050 odd mark, that seems to be a bit of a resistance zone because the 25,000 call is seeing a fair bit of open interest. And the premium out there is roughly around 50 rupees. So that's the line in the sand on the upside. On the downside, the 20 DMA, till that holds out, you'll have to say that it's pretty much a buy on dips market. And moving to the Nifty Bank, that's likely to be the big mover. It did a couple of days of underperformance last week. But yesterday, what was heartening to see was that, in fact, it made a higher low. All the other previous trading sessions, and after 7 sessions, actually, it made a higher low. So that was encouraging to see. Otherwise, you saw that it was a declining trend. Yesterday, it broke that. So getting to the levels on the Nifty Bank then, it's currently in the middle of the 50 as well as the 20 DMA. So till that 20 DMA, is holding out, till the 50 DMA is holding out, you'll have to say that still this one has the potential to move higher. So let's get the absolute numbers then up for you on the screen. Well, the Nifty Bank, the 20 DMA, we crossed it intraday yesterday. We couldn't hold on to that. So that's the resistance zone that you're looking at. The high as well yesterday, closer to that level. The 50 DMA is at around the 50,800 odd mark. You don't want to break that on the downside. You actually want the Nifty Bank to move up. So I think buy on dips continues in terms of the Nifty. The Nifty Bank should be the mover, and the Nifty Financial Services Index plays out the weekly expiry.
Okay, thanks a lot, Nigel, for that. So those are all the cues that you need to watch out for as we begin a brand new day of trade. And of course, there's so much in terms of, global action as well that we're tracking for you. But first up, let's get you some money market views as we begin the day. On the rupee front, Abhishek Goenka of India Forex and Asset Management says that the focus this week will be on the Fed policy. Though the US Central Bank is expected to keep the rates unchanged, the Fed is likely to prepare the market for a September rate cut. cut. If that happens, the market may perhaps be emboldened to price in more aggressive cuts, and this could cause the US rates to rally and the dollar to weaken. He expects that Indian rupee to underperform amidst broad dollar weakness as the RBI may look to correct overvaluation. Abhishek sees the rupee trade in a 82.90 to 83.90 range over the very medium term.
Okay, Vishal Goenka of IndiaBonds.com weighs in on the bond market. He says that bonds rallied last week on the back of technical factors such as global index inclusion, inflows and proposed LCR changes for banks, which may further decrease demand for government securities. This week will give further cues on world interest rates with policy decisions due from the US Fed and Bank of Japan, followed by Bank of England. On Thursday, he expects the RBI to hold rates unchanged in its policy next week, with the 10-year GSEC expected to trade between 6.9 to 6.95%.
Well, we've got plenty of stocks to track for you, but let's highlight the top 10 that we're looking at. We'll get into further detail in just a bit. For the time being, we run you through the list. We're looking at ACC, Colgate, KEI Industries, Data Patterns, as well as Jindal SAW. They'll all be reacting to positive news flow, and we are split down the middle. 5 in the green, 5 in the red. You have HPCL, Kalpataru, Idea Forge. You have Maharashtra Seamless, as well as PNB Housing Finance. They'll be reacting to negative news flow. Okay, all right. Well, time to slip into a short break, actually. On the other side, we'll get chatting with Neeraj Seth of BlackRock, who will be joining us to analyze all the global cues that are stacked up. Stay with us.
Welcome back. Neeraj Seth is CIO and head of APAC Fundamental Fixed Income at BlackRock. He's joining us now. Neeraj, great to have you with us here on the program. Good to see you. Prashant this side. We're talking to you, I think, in the absolutely the right week, right? Lots of central bank decisions with potential, and many of them live in that sense. Which is the most important cue to your mind? Let's start with the Bank of Japan in that sense. Any expectations, Neeraj?
Sure. So I think all central bank meetings are critical. I would say, in fact, FOMC is the core, but certainly Bank of Japan is live, and two key expectations there. The first, obviously, in terms of the shift in the bond buying program or the quantitative easing that they have been running for a long time. So do expect to see a shift there in the bond buying program. And there is a possibility that you do get a rate hike, although I would argue that that's still a 50-50 in terms of BOJ moving with regards to policy normalization here. And market is somewhat divided on that. So certainly it's a live meeting. The inflation data is supportive, but Bank of Japan, as we have seen over the last 12 months, has been very, very gradual in terms of their monetary policy normalization. So I think you can actually call it a done deal for BOJ to hike rates.
Okay,
for the Fed, Neeraj, as you said, that's a crucial meet. Do you think they will give a clear indication that conditions are now falling in place to start cutting rates?
I would put a reasonable chance that the Fed actually paves the path for transitioning towards the easing cycle starting as early as September. Now, to some extent, it always comes down to, obviously, the level of agreement within the FOMC and specifically the voting members in terms of where they get to. But the key here is I do expect the Fed to have a more balanced tone, first of all, in terms of the dual objective of price stability and unemployment or full employment. So I do think the labor market will come back in focus, which has been the case in the last couple of meetings, and a reasonable chance that they actually do open the door, given what we have seen on the inflation data, which is 2.6 on the core PCE, 3% on the CPI, 3.3 on the core CPI, which has been drifting lower, and the unemployment, which has not touched 4.1 and slightly, in fact, inching higher. So all in all, I think the balance is shifting towards the normalization or the easing cycle to begin in September. So I do expect to see an indication from the Fed while keeping the policy rates unchanged this week.
Okay, so you're saying that the policy rates will remain unchanged this week, but there could be an indication of the easing of the rate cutting cycle from the September policy. What does all of this mean for a market like India?
So the key here is broadly, let's start with what it means for the rest of the world. Obviously, if you think about the emerging markets, most of the countries have been in somewhat of a bind to not start cutting rates ahead of Fed. Now, specifically for India, I do in fact think that RBI is less constrained by the Fed. But the Fed starting on the easing cycle does open the window for RBI to look more at the domestic conditions and not get constrained by the global DM policy. I don't expect RBI to cut in the near term. It still might be a few months away, but it certainly eases up the window for RBI to look at the other side in terms of the easing cycle. So all in all, I think it actually starts creating room for the RBI to look at the easing, as I said.
Okay, hi Neeraj, good morning. Nigel on this side, and good to see you win. Well, the big event that passed us in the week gone by was the budget 2024. And there was some angst with regard to taxation on capital gains going up, particularly on equities. How did you read it, and what about the fiscal prudence that the FM stuck to?
Sure. So first of all, I do believe overall it was a good budget. And it did strike a balance between inclusive growth, infrastructure build, and the fiscal prudence and the path of fiscal consolidation. Now, there's no perfect budget. There always will be some parts where something got to give. And the increase in the long-term capital gains tax was somewhat negative, but I don't think from a long-term perspective, it changes the India story or the attractiveness of Indian risk assets. So I was not too worried about it, but you could always see an immediate knee-jerk reaction from the market. But broadly, I do believe the budget was actually good.
I mean, it was actually exactly just a knee-jerk reaction. It was exactly that, Neeraj, as I think we all saw, right? It didn't even last maybe an hour, 2 hours or so, and the market moved right back up. A great conversation, Neeraj. Hope to see you more often here on the channel. Thank you very much for joining us this morning for a quick sort of snapshot view on the most important things. We'll take a break. We are back with our top stocks with our research team on the other side. Stay tuned.
Welcome back to Bazaar Morning Call. Well, our research team is standing by with the list of top 10 stocks as we begin a brand new day of trade. So let's get straight to it. Nigel, you're watching out for ACC. How are the numbers?
Well, that's right. ACC's numbers actually were pretty much in line with what we were working with. And I'm going with green out there because on the top line, there was a bit of a beat owing to higher volumes. So the volumes came in at in excess of around 10 million tons. We were working with around 9.7 million tons. We'll have to find out further about, how much of it was solely ACC. Or was it something to do with, the deal they have with Sanghi unit or maybe the Asian Concrete unit as well? But short point is that they beat out there. EBITDA, well, that was pattern line. The EBITDA margins, though, came in a little bit lower. How do they manage this? Because realizations were rather weak, which were down by 3% sequentially. Employee cost was lower, power and fuel cost was lower, and freight and forwarding cost as well was lower. The profit number, though, that came in lower by close to 20%, higher depreciation, higher finance costs, and lower other income. Since the numbers are in line, going with green on that name.
Okay, going with green on ACC, a 9% volume growth there. But Sonal is with us to talk about HPCL and how that one looked. Sonal, over to you.
Good morning, Sonia. It was a weak set, much lower than what the poll was suggesting. Revenues came in flat at 1.14 lakh crore rupees on a quarter-on-quarter basis. EBITDA, though, halved on a quarter-on-quarter basis, leading to margins of 1.9% versus 4.2%, and profits were down 87% to come in at 356 crore rupees. The poll suggested anywhere to the tune of 1,000 to 1,200 crore rupees. It was led by the refining segment. The reported GRMs came in lower at $5 per barrel, not so much lower than what the poll was suggesting, but they did take a hit of LPG under recovery, and that is the reason there was a negative buffer of 2,440 crore rupees. The company did see the impact of Russian crude oil discounting. That's why they reported GRMs even lower than BPCL. Jefferies has an underperform with a target price of 315. JP Morgan has a neutral with a target price of 335. But Citi is very bullish on the stock. However, going with red on the weakness that we saw this quarter.
All right, Sonal, thanks very much for that. I think there was I think UBS upgraded their rating on oil marketing companies, as Nimesh was telling us yesterday. But that's a space which will continue to be active, as Sonal said. Colgate, perhaps, is also something which would stand out today with the strong earnings. Mangalam is here with details. Mangalam, morning.
Very strong earnings from Colgate this time around. It could well be the result of the season for the FMCG company. A big beat across all parameters, high single-digit volume growth in the toothpaste business, and continued pickup in rural markets for the second consecutive consecutive quarter. So if you just take a look at the numbers, revenue just shy of 1,500 crores. The street was working with a number of 1,430 crores. EBITDA above 500 crores. The street was working with a number of 470 crores. Margins at 34%. And the net profit also came in much higher, 364 crores versus expectations of 332 crores as well. And even if you look at it year on year, 13% revenue growth, 21% EBITDA growth, and 33% net profit growth is impressive, whichever way you look at it. High single-digit volume growth in toothpaste compares to street expectations of 2 to 3%. Gross margins improved, and this despite the company not scaling back on ad spend. So ad spends increased by about 10% as well. See some green on the stock despite it having run up 70% over the last 12 months.
Okay, all right, Mangalam, thanks a lot for that. Well, let's go to Upasana, who's here to tell us about KEI Industries. Upasana?
Good morning. Well, it was a good Q1 for KEI Industries. The revenue saw an uptick of 16% on a Y-on-Y basis. Cables and wires saw good growth, while stainless steel and EPC projects lagged. Now, the main revenue growth came in from cables and wire division, where revenue was up about 17% and EBITDA margins expanded by 220 basis points at 11%. Gross margins stood at 26.3% versus 25.7% on a Y-on-Y basis, and EBITDA margins also expanded sharply from 9.9% to 10.4%. Company's pending order stands at 3,590 crores. And mind you, earlier company had given their FY25 guidance, in which revenue they had said would range between 15 to 16%, which is pretty much in line with Q1. And EBITDA margins also they had guided would range between 10.5 to 11%, which is again nearly in line with the Q1 numbers. So all in all, good set of numbers coming in from KEI Industries in its Q1 FY25.
Okay, good quarter from KEI Industries. Do note we will be connecting with the management of KEI Industries at 9:30 a.m. later today, so do stay tuned in for that. But there are plenty of other stocks to watch out for. Kalpataru Projects is one of them. Vivek is here to tell us more about that. Vivek, how did it look?
Well, good morning. Kalpataru Projects are in line with its peer set, where both KC International as well as L&T call out the fact that there was labor unavailability due to the elections. The top line growth has been quite muted, execution has been muted. Now, along with that, Kalpataru also suffered from an inferior revenue mix and also weakness as far as one particular segment, that is the water segment, was concerned. Now, looking at the numbers, revenue is higher by 8.2%. This is lower than what the company anticipates for the full year. EBITDA to down almost 1%, margins 80 basis points lower, and profitability lower quite sharply at 20% on a year-on-year basis. The company said that the water business revenue was impacted due to lower collections and also shortage of manpower, and the company said margins were impacted on account of the project mix variation. What bodes well for the company, the order inflow as well as the order book remains quite strong. Order inflows of over 7,000 crore in FY25 so far, order book at 57,195 crore, and the company is L1 in orders worth almost 5,000 crores. Order book is strong, but execution this quarter has been quite muted.
All right, Vivek, thank you very much for that. Well, more numbers. Upasana has got that list. Upasana, morning.
Well, first up, let me start with data patterns. The company reported a steady set of results. The revenue saw an uptick of 16% on a Y-on-Y basis. EBITDA stood at 37 crores versus 28 crores with an uptick of 34% on a Y-on-Y basis. And company reported a strong EBITDA margin of 35.7% versus 31% on a Y-on-Y basis. PAT stood at 33 crores with an uptick of 27%, which was mainly led by higher other income. The company's won orders worth 38 crore in Q1 FY25, which is lowest in last 12 quarters, taking the total order book to 1,020 crores. Next up is Idea Forge. The company reported a weak set of numbers. The revenue saw a downtick of 11% on a Y-on-Y basis. Gross margins stood at 33% versus 56% on a Y-on-Y basis. And margins stood at just about 4% versus 29% on a Y-on-Y basis. PAT also saw a degrowth of 90% and stood at 2 crores. Order book stood at just about 4.2 crores versus 125 crores on a sequential basis, which is lowest in last 4 quarters. So weak order book and higher cost of materials has led to such a low growth in Idea Forge Technology.
Thanks a lot for that, Upasna. Well, I'm focusing on two more stocks, one in the green, one in the red. Jindal Saw. Numbers look very good. Top line growth of close to around 12%. That's beautiful. But the margin picture for the third straight quarter, it's holding at around 17%. So it seems that margin band has readjusted to the late teens instead of the early teens. So that's good news as well. The profit number was up by close to around 70%. The consolidated debt, yes, it moved up on a sequential basis, but that's more to do with working capital getting stretched. The long-term debt, well, that came down, in fact, on a sequential basis. So wouldn't read too much of a negative in that. The positive as well is that the current order book continues to swell up. Now it's holding at around $1.65 billion, which is giving you visibility for the next 3 to around 4 quarters. So thumbs up on that one. Red, though, on Maharashtra Seamless, it'll have to be a thumbs down there because revenue was degrown by close to around 6%. The EBITDA took a hard knock, down more than 45%, close to around 50% actually. And margins coming in at a multi-quarter low at only around 11%. The EBITDA per ton is something that we look at, and the seamless business, that normally drives the EBITDA. Well, that came in at less than 10,000 rupees per ton. The ERW, well, that was more or less stable on a year-to-year basis. Two positives, though. One is that the order book is still healthy, and they have cash of close to around 2,000 crores, which effectively is nearly 25% of the current market cap. So the stock starts off in the red, but later on, we'll connect with the management of Maharashtra Seamless later on the show at around 9:40 a.m. later today. So we'll try to understand what went wrong in the past quarter.
Okay, well, that is coming up at 9:40, so do stay tuned in for that. But PNB Housing is the other one that we're focusing on this morning. Vivek is here to give us the fine print. Vivek, how did it look?
Well, after a whole slew of earnings, one company that we need to focus on the back of a likely block deal today. We accessed the term sheet last evening and we understand that the Carlyle Group, which holds stake in PNB Housing under the name of Quality Investment Holdings, is looking to sell up to 6.4% stake via a block deal. We understand that the total size of the offer is a little over 1,250 crores. The floor price is at almost a significant discount at 755 rupees a share. There is a 90-day lock-in on further sale of shares by, and the book-running lead managers are Motilal Oswal as well as IIFL Securities. Remember, the Carlyle Group holds almost 32.68% stake in the company, so they're looking to pair around 6.4% stake in today's block deal.
Okay, thanks a lot for that. Here's a quick recap of our top stocks with positive news flow. There's ACC, Colgate, Palmolive, KEI Industries, Data Patterns, and Jindal Saw. While stocks with negative news flow, there's HPCL, Kalpatru Projects, Idea Forge Tech, Maharashtra Seamless, and PNB Housing Finance. Let's take a quick commercial break. On the other side of the break, Siddharth Khemka, the head of retail research at Motilal Oswal Financial Services, will be with us for some fundamental stock analysis. Stay tuned.
Welcome back to Bazaar Morning Call. Well, let's get some fundamental analysis going on a whole host of stocks that we just discussed. Sid Khemka, the head retail research at Motilal Oswal Financial Services, joins in. Hi, Sid. Good morning and good to see you, Win. Well, Colgate, that could potentially be the stock of the day. And as Mangalam said, potentially the result from the FMCG pack. The numbers are good. Some brokerages are pointing out, though, that the stock has rallied 30% in the last 6 months. And valuation-wise, may not be very supportive. But those numbers are very good. Your take?
Good morning, Nigel. Glad to be on the show. Yes, I think if you look at the overall consumption pack, the results have been better. And what is heartening to see is that the rural sector is doing much better than urban. And the same was the case with Colgate. Volume growth of 13% is much better. I think that is something which is heartening. Margins have improved almost to 20 basis points with moderating RM costs, cost savings initiatives, and price hike-led strategy, which is a very good thing that the industry is able to pass on price hikes. So I think overall, with respect to Colgate, the toothpaste segment is doing well. Toothbrush, a lot of competition is there, so mid-single-digit growth there. The personal care portfolio, we believe, is under-indexed, and we would like to see Colgate to boost its portfolio in that segment. Having said that, back-to-back 2-3 quarters of good numbers, so stock should do well in the near term. Valuation-wise, at 55-56 times P on FY25, I think a little bit expensive. So a lot of this growth has been captured in the price. So in the near term, we would continue to see strong numbers, but I think the upside can be capped from a one-year perspective.
Okay, so the numbers will be strong, but upside will be capped. What about ACC? The numbers were largely in line. Volume growth was not bad at 9%. And this entire cement space is in focus, right, after all that's been happening over the last many quarters. Your thoughts on ACC particularly?
Good morning, Sonia. So yes,
Morning.
I think sales volume growth of 9%, much higher than our expectation of 3%. But there was some issues with kind of realization, which was 2% below our expectation. And that led to EBITDA being about 7% below our number. So EBITDA stood at 664 per ton. Compared to our estimate of 736 EBITDA per ton. So kind of some pressure on the operating margins. But if you look at the overall industry outlook continues to be strong. Management is positive and expects the demand growth in the range of 7 to 9% in FY25. This would be supported by the higher government spending towards infrastructure projects, construction of roads, highways, and the Q1 growth of 9% kind of supports the overall the demand environment. On back of it, if you look at ACC is also taking initiatives to reduce costs, some of the projects that they are taking, and that should lead to improvement in EBITDA going forward. So we believe that with the expected improvement in profitability, especially led by some of the cost-saving initiatives and structural changes in the operations, which will drive valuations going forward. So we maintain a positive view with a buy rating and a target price of 3,300 on ACC.
Good morning, Prashant here. NTPC, if you want to comment, there were earnings, there was the investor meet as well, analyst meet as well. I'm not sure if you sort of looked at it, but aggressive capex plans and really a lot of commitment to be a relevant player. I mean, of course, it's the largest player, will be relevant, but sort of very aggressive plans on capacity addition, both on the thermal side, on the renewable side as well. Power Grid reported numbers. We had some commentary from the management in the afternoon yesterday. Do you think that entire space, even for example, names like REC, PFC, which are taking it a bit slow lately, this entire pack could be active once again?
Yeah, Prashant, good morning. So I think, yes, the entire power sector is in limelight. They have been in focus. Industrial growth is picking up. Economic, so GDP growth is strong, but the large part of the demand comes from the industries, and we have seen that the record power consumption for India for the last couple of quarters, and that is supporting the utilities. What is also good to see is that most of the utilities, be it on the public sector or on the private side, having a lot of focus on the renewables. We have seen how NTPC has a large portfolio on the renewable side, and the NTPC Green IPO is likely to hit the market sometime soon. Even Tata Power has a large renewable business, and they have sold stake in that to some of the global PE firms. On back of that strong demand, some of these power financing companies, they have also seen improvement in the overall financials. So be it Power Grid or NTPC, the numbers have come out pretty strong. And I think the demand drivers for the power sector with a mix of renewables as well as the traditional fuel would continue to be pretty strong.
Now, we'll take a break here. Actually, you know, when we're talking about power, just look at where Voltamp left off yesterday, right? Of course, it reported very strong set of numbers. Numbers came out in the afternoon. Stock was up 18%. And that's a large name, the largest transformer company in the country, but 14,173. That was yesterday's close. We'll talk about this as well. But we have to take a break, and we'll be joined by our first management here. Quest Corp will be joining in to discuss their first quarter performance. Stay tuned.
ग्रो निफ्टी ईवी एंड न्यू एज ऑटोमोटिव ईटीएफ में इन्वेस्ट किया। गवर्नमेंट ने ईवी सेक्टर में लगभग 11,000 करोड़ इन्वेस्ट किया है। बैटरी प्रोडक्शन में 18,000 करोड़। सरकार चाहती है 2030 तक 30% व्हीकल्स इलेक्ट्रिक हो। आज ही इन्वेस्ट करें।
म्यूचुअल फंड निवेश बाजार जोखिम के अधीन है। योजना से संबंधित सभी दस्तावेजों को ध्यान से पढ़ें।
बैल्कनी
सेम है।
ड्राइंग रूम
भी सेम है।
किचन एरिया
सेम है।
हमने लिए 90 लाख में, आपने लिए 80 लाख में।
ये सेम क्यों नहीं?
क्योंकि आपके और हमारे होम सर्च ऐप सेम नहीं है। जानिए प्राइस ट्रेंड्स और सही ट्रांजैक्शन प्राइसेस ऑन 99acres.com। घर लेना हो या बेचना, 99 acres से ही पूछना।
I just love zero, क्योंकि मेरा बैंक जो है ना वो जीरो चार्ज करता है।
जीरो? कौन हो तुम ब्रो? जीरो चार्जेस? ये तो हम सबको नहीं मिलता है।
नहीं मिलते थे ब्रो डिस्को के जमाने में, और मेरा बैंक जो है ना सारे सेविंग्स अकाउंट सर्विसेज पर जीरो चार्ज करता है।
ओह,
IDFC फर्स्ट बैंक में अकाउंट होगा
तुम और मिलेगा।
हाँ, ये किधर से मारा तूने?
आपकी अलमारी से।
अबे चल, ओरिजिनल नहीं है।
किसने बोला?
हाँ मैं बोल रहा हूँ,
मैं भी ओरिजिनल नहीं।
Akums Drugs and Pharmaceuticals Limited now proposes an initial public offering of its equity shares. The 100% book built offer is being offered at a price band of rupees 646 to rupees 679 per equity share, of face value rupees 2 each. Offer opens on Tuesday, July 30, 2024. Offer closes on Thursday, August 1, 2024. The anchor investor offer period opens and closes on Monday, July 29, 2024. For risk involved and other details, please refer to the red herring prospectus, which is available on the website of the company, the SEBI, the BRLMs, and the stock exchanges.
World Food India 2024, aiming to become the food basket of the world, a global event to showcase the food processing prowess of India. Ministry of Food Processing Industries, Government of India invites you to World Food India 2024, 19th to 22nd September, Bharat Mandapam, New Delhi.
PhonePe proudly presents Share.Market. Open a Demat account by 31st July and get zero brokerage till 31st December on F&O and intraday, equity delivery, wealth baskets, and zero account opening fees. Download Share.Market and start investing. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.
Whenever I had ice cream or cold water, I would experience a sharp shooting sensation. So I just kept ignoring it. Even my hot chai was giving me the same amount of discomfort. My dentist recommended Sensodyne. So now I can be completely carefree and sip my hot cup of tea. It really works.
Eat it on time. And please, ride the bike slowly.
Okay.
And this is for your safety.
Arey, I almost forgot.
LIC.
This is for our safety. दिल की सुनो.
LIC चुनो.
LIC, हर पल आपके साथ.
Welcome back. As promised, let's focus on Quest Corp now. Q1 was a slow quarter for them, with the EBITDA and margins witnessing a hit due to wage inflation and seasonality. The domestic IT staffing gained momentum, but international IT markets remain muted. Guru Prasad Srinivasan, who's the executive director, and the group chief executive officer, Kamal Pal, is also with us. Kamal Pal Hoda, who's the Group Chief Financial Officer at Quest Corp. So we have two gentlemen joining in. Mr. Srinivasan and Mr. Hoda, thank you so much for joining in. Mr. Srinivasan, I want to start with you. You know, if I go through the numbers, right, in what was a seasonally weak quarter for you, your annual contract value was very strong at 660 odd crores. Can you tell us what is the kind of visibility that you have for the rest of the year? Is it possible for your company to hit a double-digit revenue growth?
Sure, Sonia, thank you so much for having us on the show. First of all, I think we stepped in quite stronger than anticipated in our Q1 FY25. We have done a net add of about 30,000 plus headcount. If you look at, this is perhaps a combined number that we would have delivered in Q4 and Q3. It's a good start, the way we have got the head start into FY25. Our quarterly revenue is 5,000 crore. That's the second milestone. It's a good momentum for us to go forward from here. Yes, as you said, we have added about 160 plus logos, which is adding to about 660 crores by annual contract value. It emphasizes the kind of strong investment and the focus that we have got on sales, and will also set the context for the coming quarters as we move forward. Q1 is generally, there is a seasonal slowdown in two of our businesses. GTS, which is our global technology operations, normally will have a very high Q4. And Q1, the collection business specifically from BFSI tapers down a bit. So that's one impact. And it is also a high margin business. When it tapers down, there will be slight seasonal slowdown in Q1. Plus, in our integrated asset management business, we operate into a space where we work with universities and institutions in terms of food and beverage management. So that is again a high margin business which slows down. So these two are by plan. I think we are definitely on to the plan, and Q1 is slightly a seasonal decline, but otherwise we are all set for this year to steadfast in terms of our growth.
Okay, so you said you added a headcount of 30,000 and Q1 was stronger than anticipated. Just one follow-up question there. You know, your main business, Mr. Srinivasan, 70% of your revenue is workforce management, and the Q1 results have shown that Indian IT companies are now sort of clawing back to hiring. Hiring is picking up a tad bit. But your own presentation showed that domestic IT staffing has gained momentum. So just wanted to understand, in terms of workforce management, in terms of hiring, what is the outlook going forward? What kind of numbers are we looking at? And what kind of margins? I mean, do you see a scope for margins to go up since IT hiring has picked up?
So that's right. So compared to Q4, our mandate by percentage is almost up by 36%. So, we were about 1,100 mandate in Q4, and I'm almost seeing about 1,500 mandates currently as we, moved on to Q1, which is very good recovery, I must say. And as we move forward, definitely, we are seeing green shoots coming in. As IT hiring picks up, the margin, there is definitely a scope for margin improvement because it comes at a higher margin, and we work on an average wage of about anywhere between 75 to 80,000. And these are largely, again, towards GCCs. Almost 78% of our hiring is for GCCs. So it will definitely help us in margin expansion as we move forward.
Okay. Gentlemen, morning. Prashant here. Mr. Hoda, let me come to you. So you left off FY24 with about 19,000 crores in revenues. What can we expect in terms of growth in FY25 for the full year this year? That is one. Will you grow that by at least 15%? And second, I think you had guided for some improvement in margins through the course of this year. So if you could quantify that as well.
Sure. Thanks, Prashant, and glad to be on the show. You're right, and as Guru explained, we started on a strong footing, and we started with 5,000 crores of revenue run rate for the quarter. So we, our internal estimates are we should definitely clock in a double-digit growth, and it should be definitely higher than, in the range of 14 to 15%, like you said. As far as EBITDA margins is concerned, again, we are on plan as far as Q1 is concerned. Strong set of results despite the seasonality. And we feel that there is a possibility to at least do a 35 to 40 basis points higher margin as we progress through the years. Also on the growth, I think the budget has been very progressive. It has been around formal employment. It has been around skilling, and being one of the largest domestic players in manpower, we feel we can, participate in the progressive growth that this budget has outlined.
So margins could be around 4%, Mr. Hoda, for the full year?
Yes. As we progress through the year, we should definitely cross 4%.
Got it. So 14 to 15% revenue growth and about 40 basis point improvement in margins for FY25. Gentlemen, we'll leave it there. Short on time, Mr. Srinivasan, Mr. Hoda, appreciate your quick comments there. Very useful, appreciate it, and good luck. We'll speak again soon. So that's the management of Quest Corp coming through. We still have Siddharth Kemka with us, and let's just sort of take it right back to him. Siddharth, you looked at, Sonal earlier was highlighting numbers from HPCL. IOC will report numbers today. It's a bit of a sharp miss for HP. What's the view coming in?
Yeah, Prashant, so I think there was a big miss, especially on the EBITDA front, and that was because this was attributed to the LPG under recovery of almost 2,350 crores. What our analysts are saying is that this could be mostly reversed later this year as LPG remains a controlled product. And but for now, if you look at other numbers, I think HPCL reported good numbers. So the refining throughput was 7% above our estimate at a 5.8 MMT. GRM's kind of a bit below our expectations. So overall net, I think a mixed set of numbers from HPCL. The entire thought process that the OMCs would start structurally reporting strong numbers and the re-rating I think would now depend on the details post the con call, which my management would clarify. So overall, we continue to be positive on OMCs. We believe structurally there is an upcycle for the oil marketing companies as well as the upstream and downstream. So we are positive on ONGC, Oil India, HPCL, IOC. So these are our preferred picks within the overall oil and gas space.
Okay, thanks a lot for that. We'll do one thing, we'll come back for more on individual stocks. But for now, let's take a quick commercial break. On the other side of the break, Mitesh Thakkar and Sudarshan Sukhani will join in for some technical trades. Stay tuned.
Okay, welcome back. You're with us here on Bazaar Morning Call. We've got, 9 minutes to go for the pre-open session. Mitesh and Sudarshan are with us with their perspective on what trade could look like. I mean, really, in terms of a handover, there's nothing. But there's a lot to look forward to over the next 3-4 days. Gentlemen, morning. Mitesh, let's start with you. GIFT Nifty is indicating a 60-point lower start. How would you trade it?
Good morning, Prashant. So I think, yesterday we did see an attempt to get past 25,000. Not only is psychologically important, there's also a lot of call interest data, call open interest around this level of 25,000. So my sense is that you might take a breather for a day or two. So on the index, I think, especially with the bank Nifty also not remaining strong, it turned kind of weak towards the end of the day. I think on the index, you might want to, look at some declines and then buy into it. 60-point gap down is very welcome, but my sense is that we might actually see levels of 24, 550, 600 zones, which could be the welcome or which would be the buying area for me. And then keep a stop below 24, 500 from there on and take a long position. So wait it out. I think, but individual stocks are offering a lot of action, and I think that's where the focus is.
Okay, the focus is on individual stocks. Got that. Sudarshan Sukhani is also with us. Sudarshan, would you concur with that view that perhaps we're, getting into some sort of consolidation for the market, but all the action is in individual names?
Yes, good morning. You are quite right. Mitesh is correct. It is. I would also assume that the markets will consolidate. The only question is what will be the range, and it is possible that we may have a large range in which the markets chop around downside and upside. So we'll just find out the contours of that range in a day or two. But for the time being, 25,000 is resistance, and I don't think we should be looking for any trade beyond that. If there is a dip today in the Nifty, say a 50 to 100 point dip from the opening price, wherever it opens, then go long, and your latest targets are 25,000, although you would like to exit before that. That's the trade for the Nifty in the morning.
Okay, all right. Thanks, gentlemen, for that. Let's get to stock specific then. Sudarshan, you go first. What's the stock on your radar?
Well, there are a lot of stocks that are doing well, a lot of mid-cap stocks. Balkrishna Industries is a buying opportunity with a stop under 3,200. BHEL is a buy again with a stop under 310. Just look at the charts of BHEL and how it has flown. City Union Bank is a buy with a stop under 163. And Escorts again is consolidating and breaking out, a buy with a stop under 4,000.
Okay. Mitesh, what about you? What are your trades?
Yeah. So on the stock side, I have more of buy calls, 3 buys to a sell today. On the buying side, I have Bandhan Bank, big breakout after the numbers, and the stock should see further continuation. So in case we get it slightly lower in today's opening trade, around 215, 216, take a stop below 210, look for targets of 232. DLF is a buy, conditional buy. I would want to see the stock price get past 880, then buy with a stop at 864, look for targets of 915. A sell on Hero Motors with a stop at 5490. And here I would look for targets of around 5,300. That's one stock, which is showing some negative pattern on the intraday charts. And I have a buy on ABFRL with a disclaimer that we have some call options position. So there's vested interest, but the stock managed to get past the consolidation, which was, there for the last 3 to 4 weeks between the range of 335 to about 310. So therefore it could see further upside. So buy here with a stop at 334, look for targets of 355.
All right, gentlemen. Thank you very much, Mitesh and Sudarshan. Appreciate you joining in. We'll come back with sort of more questions, individual names, some follow-throughs, which are starting to fade, some which may continue, and many more stocks as well. Thank you for now. We'll take a break. We're back with the pre-open session, which is about 5 minutes away. We'll also be joined by the management of Zentech, which has reported a blockbuster set for the first quarter. So we have Ashok Kalturi joining us to discuss those numbers in just a bit.
Welcome back. Well, we have Sneha Seth, who is the derivatives research analyst at Angel One, who joins us now. Sneha, hi, good morning, and good to have you on the show. You know, this market has been a bit confusing, right? So while the headline index is hitting new highs, now there's an expectation of consolidation. Your thoughts, and what are the stocks that you're looking at today?
Very good morning, Sonia. If you look at market, yes, yesterday's profit taking from the higher levels with especially writing in call options and unwinding in put options. We have also seen unwinding in 24,600, 700 strikes. So that clearly indicates that we may see some further profit taking from current levels. So on the higher side, 25,000 should be acting as a very strong hurdle. On the lower side, 24,500, 600 should be acting as a support. So individual counters, however, they are showing decent risk reward ratio at this point in time. So one can focus there. So in individual counters, the first counter which I like is L&T. This counter was up nearly 2.5%. It has given a breakout above the resistance zone place around 3,700. So I believe we can see this counter moving towards 3,900. So one can keep a strict stop loss around 3,710. Apart from this, Jubilant Food, this counter looks good. This counter again looks poised for an up move beyond the resistance zone of 590, 595 zone. So I would recommend buying this counter with a strict stop loss of 584, and the target expected will be around 620.
Okay, thanks a lot for that. So those are a couple of ideas coming in from Angel One. But moving on, the RBI has said that the coming new issue of 14-year and 30-year government bonds won't be issued under the FAR route or the fully accessible route, which means foreigners can't buy unlimited quantities of these bonds. What does this really mean? Lata is here with her editor's take. Lata, over to you.
Yes, both government and RBI have moved in and said that any future issuance of 14-year and 30-year bonds will not be classified under the fully accessible route. Now, when was this fully accessible route born? It was born in FY20 with the aim that one day Indian bonds will be included in the index. And that's what happened a few months back. India got included in the JP Morgan index. One of the rules of the index is that a large number of bonds should be available in a particular category to be included in the index. There should never be a liquidity crunch in those bonds. Now, with this restriction coming in, these bonds will come into the non-FAR category. In the non-FAR category, it was before, the index inclusion, all bonds, FIs are eligible only to buy up to 6%. So now in the new issuances, it will be 6%. And in all the non-FAR bonds, the FIs can buy up to 6%. What is the impact? Or first, what is the reason? The big reason for this is Reserve Bank and Government of India have always been uncomfortable to allow too much of debt money. They have no problem if unlimited amount of equity flows in, but India being indebted, especially the sovereign being indebted to foreign entities, is foreign to Indian idea. The immediate fear, market fear, is also that the tail will wag the dog. At some points in time, all emerging market countries, debt is dumped, and we could be, people in India could get hurt, even corporates, because when government bonds fall, even CPs and CDs tend to fall. So there was that fear, and perhaps all that has led to this restriction. Now, there is a crib among some people I spoke to that, this means there is policy flip-flop, policy uncertainty. But no dealer expects actual bond prices to be hurt. One, because, when the index inclusion happened, $400 billion worth of Indian bonds became eligible for index buying. But what is the total buying that will come even when the index inclusion is fully 10%? Just about 25 or 30 billion. So, fears are exaggerated. As well, the FIs normally prefer shorter term bonds, like, below 5 year. So even the normal under 6% route, they were not really buying the longer term. If you looked at the 14-year and the 30-year itself, in 30-year they are hardly there. About 500 million they have bought. In the 14-year, they've bought over 6%. But it's really not going to impact actual prices. But yeah, sentiment could be mauled.
Okay, all right. Thanks a lot for that, Lata. Well, we're getting some pre-open rates that are coming in as well, and a few stocks that are calling for attention. One of them is ITD Cementation. That's up more than 5%. Jindal Saw as well was higher. And the big stock of the day is really Colgate. That is up, I think, close to 7% in pre-open. And also the other one is HPCL. We'll get some analysis going. That's down close to 10% in pre-open rates. But let's focus on Zen Technologies. Quarter one was a decent one. The revenues grew by more than 90%, and also had a 60% growth in profitability. The gross margins contracted a little bit, and new order wins was a little bit subdued. Mr. Ashok Atluri, the chairman and MD of the company, joins us on the show. Hi, Mr. Atluri. Good morning, and always good to have you on the show. Give us a couple of basic details first. You had guided that in this year, the revenues will double in comparison to last year. You look to be on track for that. Do you want to stick to that guidance, or do you want to up it? And also exports, I think you guided for close to around 300 crores of revenues from exports. In quarter one, it was absent. You want to revise that number downwards?
Yeah, so we have assured that we would do about 900 crores. So we expect to do about 900 crores. And that guidance remains, Nigel. And with respect to the exports, you know, so again, the export target absolutely remains that it will be 300 crores. And we, again, it's not in a perfect proportions that the domestic and exports happen every quarter, but over the year this is what was, and we still stand by that. So those are two things. Yeah.
Mr. Atluri, morning. I mean, last time we spoke, you said it's an unprecedented positive environment for the business. It's been an unprecedented positive environment for your stock as well, which is which is zoomed. Now, you also told us that you're looking for acquisition opportunities at that point with some IP. Are you closer now than you were a month, 2 months back?
Yeah, I mean, we are talking to some companies, but we haven't really any near to closing the deal. But yeah, we have been talking to both Indian and foreign companies. But maybe in the next couple of quarters, we should be able to hear something about it.
Next 2 quarters? You'll
close
quarters, something?
Yeah. Yeah, but so we may be closer to announcing something. Yeah, so
okay.
At this point in time, there's nothing. Yeah.
And what kind of size, etc.? I mean, broadly, roughly.
I mean, it will depend on the kind of, but we are little flexible between 100 to 500 crores kind of thing. But yeah, we are flexible about it.
Okay, Mr. Atluri, good morning. I wanted to talk a little bit about your order book and the order wins. The order book currently stands at 1,160 crores, but I noticed that your new order wins stood at just about 11 crores. Can you tell us a little bit about that? Are you seeing slower movement in terms of orders? And what is the kind of visibility that you have? Any reason why there's no significant win in this quarter?
So we have indicated almost in a couple of quarters back that all our orders will be expected in the fourth quarter, but some may start trickling in on the third quarter. So this is a typical order cycle that we have seen in over many decades. Only last year there was an exception because there was some emergency procurement was done. But the regular procurement typically is heavily weighted towards the last quarter.
Okay. So any numbers that you want to give us in terms of, any fresh orders on the export side, on the domestic side? 70% of your domestic order book comes from the training simulators space, and you also have anti-drones, of course. But going forward, where do you see a large chunk of your orders coming from?
So, we will continue to get the orders from these two segments. I think maybe it will be a little more in favorable of anti-drone systems because we are seeing that lot of traction that product has now, a lot of demand, not only domestic but exports also. So yes, we expect the orders to come in during the third and fourth quarter, and they will significantly, again, we are saying that we should be able to achieve a CAGR of 50% next year onwards. So we still feel confident that may be reached by us.
Okay, all right. You want to comment on the margins, Mr. Atluri? 40% margins on an average for the year. Should we stick to that?
So we have been saying that it will be around 35 to 37% EBITDA and around 25% PAT, and we would like to stick to that.
Okay, all right. You know, Mr. Atluri, we here at CNBC-TV18 had covered the stock and explained it to the viewers when the market capitalization was less than 1,000 crores. Currently, your market capitalization is around 14,000 crores. You know, we had just explained it to our viewers. The question I'm asking you is, now you could potentially raise 1,000 crores via QIP route. And that's something that the markets are waiting for. When does that take place? Is it dependent on that inorganic acquisition? Or do you think any which ways you'll go ahead, say in this quarter or so? That's the second quarter.
So we have an enabling provision we have passed with the shareholders, and that is available to us. And depending on the internal decisions and the discussions, we will raise the money so I think both may happen simultaneously or little consequentially. But yeah, we have the power to raise the money. There's no doubt about that. And if required, we will raise it.
So a couple of quarters to hear about that inorganic growth, and maybe in the next couple of quarters, we'll hear about this QIP as well. In calendar year 2024, both will be folded up, right?
Yeah, so I wouldn't really mention the dates like that, but yeah, we would be moving in that direction, absolutely.
Appreciate you joining in, Mr. Atluri. 900 crores of revenues for this year, margins at around 35 to around 37%. Exports, you're sticking to that 300 crores and sounding extremely confident about business. Look forward to chatting up with you rather soon. Just take a look at that. 40% in the last 1 year or so, but I think in the last 6 years, the stock is up more than 10 times. You know, that's the big move that we've seen. Well, Sudarshan Sukhani is back with us for the 9:10 call. Sudarshan, please go ahead.
Consider buying Balkrishna Industries with a stop under 3,200.
Got it. And Mitesh, what about you?
I'll go with the buy on Bandhan Bank on a mild decline. Add here for targets of 232.
Okay, a couple of stocks that are, in focus this morning. Of course, Colgate is the one that I want to look at, given the kind of, very strong numbers that the company came out with. A lot of positive brokerage reports, so Colgate will be up for you on your screen. And then you also have ACC. Despite a good decent set of numbers in pre-opening, the stock is down in trade. So lots of stocks in focus. Nimesh is here to give us the standout brokerage report of the day. Nimesh, over to you.
Hi, morning, Sonia. So today's standout is on MCX. Well, the stock did react to earnings yesterday. UBS has gone ahead and raised the target price on MCX further to 5,000 versus the earlier target price of 4,300. Now, they believe that while quarter one was good, quarter two is going to be even more stronger. So, on back of that, they've raised the earnings estimate for FY25 and FY26 by 10% and 16% respectively. They believe that the operating leverage benefit with rising volumes is still not priced in the market, and further new product launches, including the weekly expiries, can potentially add further in terms of earnings. So, they're justifying the high multiples given the strong growth outlook as well as supportive regulatory environment. So, on back of this, a big upgrade on UBA on MCX now. Target price raised to 5,000 from 4,300, and they've raised the earnings as well by 10 to 16%.
Okay, all right. Nimesh, thanks very much for that. Let's look at HPCL as well. Once again, Sonal is here with details. Sonal.
Well, that's right. HPCL reported a weak set of numbers. It was a top-down miss that we saw this time. Revenues were flat at 1.14 lakh crore rupees. EBITDA almost half to come at 2,110 crore rupees. Margins at 1.9%, which is much lower than what the street was working with at around 3%. Profits were down 87.5% as well. The reported GRMs came in at $5 per barrel versus an estimate of $5.50 per barrel. This was led by the narrowing Russian crude oil discounts. That is what has impacted HPCL, and they have the highest exposure to the marketing segment as well. They reported GRMs which were lower than BPCL as well. The company has a negative buffer of 2,440 crore rupees. This is because of the LPG subsidy under recoveries, and that is something which impacted BPCL as well. Brokerages, they are divided but largely on the underperform side. Jefferies, for instance, has an underperform with target price of 315. JP Morgan has a neutral with target price of 335, and Citi has a buy with a target price of 420 on the stock. But yes, overall it was missed this time around.
Okay, and Colgate really will be looked at very closely. Mangalam is here to tell us more about that. Mangalam, people can't be brushing their teeth a lot more than they already are. So more people brushing their teeth, perhaps, right?
You'll be surprised at how little people brush their teeth as against what they're supposed to, especially in, you know, some part of the urban India and a large part of the rural India as well. And that's exactly what's working for the company. Their brush twice daily campaign. So 13% revenue growth, 21% EBITDA growth and 33% net profit growth is what the company has posted. High single-digit volume growth in toothpaste business as well. We have some brokerage notes coming in. Jefferies has upgraded their EPS by 6%, and they are saying that this is the third straight quarter of EPS upgrades. They've retained their buy and revised the target price to around 35.70 as well. ICICI Securities, they estimate the volume growth at 8%, price mix growth at 5% as well. They're only saying a risk is that market share losses to naturals because of the price hikes that the company is taking in their toothpaste could be a bit of a risk. At 50 times, they retain hold rating. And Bank of America, they already have an underperform rating on the stock, but they've upped their target from 26.60 to 31.75. They've ascribed a 20% premium to the average forward multiple over the last 5 years as well. But they still say that valuations factor in medium-term upsides. But for now, these numbers are good. Let's see how the stock reacts today.
All right, lots to track. Mangalam, thank you very much for that. So that's Colgate on the upside, HPCL on the downside. And I think we'll have MCX come up as well in the pre-open session where we can take a look at it. Maybe just a few other names. That's Colgate, MCX and HP. By the way, the Nifty is absolutely flat. At the end of the pre-open session, nothing at all. So it's a very, very quiet indicative opening on the Nifty. So 24,839, a 3-point change is what the pre-open has left us with. And I think something similar out there in the sensex as well. Lots of follow-through moves maybe from yesterday because the broader market was vibrant. 1% gains on the mid-cap and small-cap indices yesterday. So we'll keep an eye out on that as well. This morning, at least the indicative opening on those indices is slightly better than what large caps are going to start the day at. So just a few seconds now, Sonia.
Just a few seconds, but I'm still thinking about what Mangalam said, where not all Indians are brushing their teeth twice a day. So only 1/5 Indians brush their teeth twice a day. I mean, that is like, either that's a marketing gimmick on Colgate's front or...
That's a big That's a big TAM. All right, that's the market open. The first rate starting to come through. We've got what 20. It's red, sort of flipping into the negative. 9-10 points, 12 points, 24,818. Flattish start actually. 60 points down on the sensex, 81,285, and this is basically what you have in terms of the opening rates. So very, very quiet. Now the Bank Nifty is down about 100 points, about 0.25% lower that is. And I think the mid and small cap indices perhaps better because you can see the market breadth in terms of how stocks are starting out. And that is in the positive, 2:1 in favor of advances. Small cap index is up about 1/4. Mid cap index is more flat. So, I think we'll have to go straight to stocks because as far as indices go, not very much.
Absolutely. So, the top mover right now is NTPC. NTPC actually reported a good set of numbers and a lot of brokerages have raised their target price on the stock. Jefferies has raised it to 485, which is a big upside to the current market price. So that's your top gainer on the index. Apart from that, you have Power Grid, Asian Paints. M&M comes out with numbers tomorrow. Ahead of that, the stock is up in the green. So keep an eye out there. Dr. Reddy's, Titan and Adani Ports are a couple of other stocks. Stocks in the news, Colgate, let's take a look at that one. Strong earnings, revenue growth of 13%, high single-digit volume growth in the toothpaste segment. That's really, off the charts right now. So 3% higher on Colgate. ACC, let's look at that one. The volume growth was not bad, 9%, but the stock in pre-opening was seeing a little bit of pressure. In terms of result reactions, I want to look at data patterns because the earnings were very strong. The EBITDA growth was 34%. The margins have improved quite a bit. The stock has gained quite a bit over the last many weeks and months, so maybe some profit taking right now. And a couple of other names, Maruti, M&M will be reporting their earnings tomorrow. So ahead of that, these two stocks will definitely be in focus. There's a large trade that has taken place in PNB Housing as was expected. So keep an eye out on that. PNB Housing now down about 1.5%. And on the upside, ITD Cementation has some positive business updates going for itself. So ITD Cementation is up almost about 1.5%.
Well, that's right, Sonia. Let's highlight a few more movers. Pfizer, the first quarter's numbers were quite good. Revenues are up only 6%, but EBITDA was up by close to around 60%. So that one, in fact, the margins are coming in excess of around 31%. That explains why that's running away. Idea Foods, that's casualty of the morning. The revenues came in lower by 11%. The margins as well have contracted to just around 4%. Remember, this one had listed with solid gains. For the time being, the one's getting clobbered. It's down close to around 10%. So big downtick is what we're seeing on that one. Zentech, we just had the promoter joining us on the show and in fact sounding very, very optimistic about the year. They're saying they're going to be doubling their revenues at around 900 crores, sticking to their export guidance as well of around 300 crores, and also mentioning that there could be a QIP and inorganic growth in the offering. So it's up close to around 4%. A few more notable movers. You have Maharashtra Seamless. Numbers are very disappointing. In the next 20 minutes, we'll know why. The stock is down close to around 5%. And Jindal Saw, well, that should have opened up well in the green. Margins holding at around 17%. Solid order inflow as well. That's something that the street likes. That one as well. Flying away as we speak. Another big mover actually is, Asahi Songwon. That's up close to around 15%. Volumes are only around 200,000 odd on that one. So maybe lower volumes, but that one in fact is up big time as we speak. Prashant.
We were talking about NTPC, so keep an eye out on that. 2.25% higher. It's a solid start. And maybe the other it's the entire ancillary space as well, right? There is the utilities, there are equipment companies, transformer companies, financiers. NTPC is the flag bearer, the torch bearer for the sector. I mean, NTPC says, well, they want to add capacities in the future. It needs to be financed, equipment needs to be supplied. Of course, prices and valuations will matter, but for now the stock is higher. I'm looking at REC, it's kind of flat right now. Look at Power Grid. Power Grid is up about 1.5%. And maybe, some of the other big movers in the transformer, smaller companies really. These are the big ones. I mean, names like the financing side and, of course, the utilities like NTPC and Power Grid as well. In the broader market, Colgate is starting to see some attraction once again. It's up 4%. Suzlon is up 3.5%. Crompton, I think we mentioned it. It's up 5%. ITD we mentioned. Paytm is starting about 3% in the green. CESC, we had that interview with our colleague Shireen interviewed Sanjeev Goenka. 4% higher on CESC. Stocks at about 174. And the other one, which is Philips Carbon Black, again a Sanjeev Goenka Group company, 3.5% higher. Those are the two companies, and very aggressive guidance from Mr. Goenka to us yesterday in that interview for both these businesses, especially for Philips Carbon Black. Novama had a big day yesterday on the wealth management side. It's up another 3% or so. 6199 is where Novama is now trading at. And there was 361 as well, which did very well in terms of trade. And we'll see if that is true right now as well. I think we'll take it to our next company, and we'll come back to the market in just a little later. We'll have Pankaj Tibrewal joining us, but we'll talk about KEI Industries for now. So first quarter was a good quarter for the company. They've seen improvement in revenues and margins. Cable and wire segment also saw healthy growth, but stainless steel and EPC projects lagged a bit. Mr. Anil Gupta is Chairman and Managing Director at KEI Industries. He's with us right now. Mr. Gupta, good morning, sir. Thank you very much for joining us. I want to just start with what's the situation on the input side, Mr. Gupta? What has been happening? Because you've been telling us our last two interactions that you've been revising your price lists every 10-15 days because of what's happening on the copper side. Could you tell us what is the latest now?
Yeah, good morning, Prashant. In fact, the latest position is that copper prices has come down substantially, and but a lot of price increase were done in April, May, and June. And now there is a bit of downward trend, and so we are revising the prices lower. So as I have been saying in last several years of my interactions with you, that we are always maintaining our price level and with respect to the input cost, and also keeping the inventories of inputs, like especially the metals like copper and aluminium, linked to our order booking. So we have never had any issue with the increase or decrease in the prices of metals.
Okay. All right. Hi, Mr. Gupta. Good morning, and always good to see you. And the numbers look quite good, actually. And if I compare it with your peer group, you seem to have grown faster than what the peer group has grown. So if you could tell us, according to your analysis, do you think you have gained some market share? And also earlier, you were guiding for around mid-teens growth in this year. Sticking to that, you want to up it?
I stick to the growth projection, which I had given earlier, around 16 to 17% in the whole year. This quarter, we have grown by around 18%, 17%, and 16%. But in volume terms, we have grown by 18%. And truly speaking, we had up the production by 25%, but a lot of material could not be dispatched due to quarter end issues and logistics, especially the exports. That is the reason that we still have given lower sales volume and lower sales growth.
Okay, so you produced more, but some part of that, because of logistic constraints, you couldn't push it out. So my question to you is, have you gained market share? If I look at the cables and wires business of your peer group, you have done a little bit better. So according to your analysis, you think you gain market share?
We have not analyzed that aspect, and I don't have any comments on that.
Okay. Sir, good morning and thanks for joining in. You had spoken earlier that your long-term goal is to reach 20% of export sales. How are the export markets doing right now? What kind of growth are you looking at in the near term?
This year, export markets are doing very well, and we expect to grow our exports this year by around 30 to 35% over last year in the overall scenario. Maybe in some quarter it may be less, or in some quarter it may be more. And as soon as our new capacities comes on board, we will push towards more exports from our new plants.
Okay, so you're saying 30 to 35% growth in the export markets for FY25 is what you're penciling in, and as soon as your new plants kick in, then more growth will go in towards the exports. Got that. So your export revenue share, what is it at now, and by when do you think you can get it to say 18 to 20%?
This quarter we achieved around 11%. This year our goal is to achieve around 15% of our sales coming from exports overall in the full year, and maybe FY26 we could reach to 18 to 20% level.
Exports, earlier you were guiding for higher growth. Now you're talking about 35% growth. I think earlier you were guiding for 45 to 50%. Not that 35% is not great, but I think exports you were talking about 45 to 50% growth, right, on a year-on-year basis?
It may happen. I mean, I'm a bit conservative because we still have little capacity constraints in our some of the products, especially the HT cables. So that is why I am giving little lesser, projection. But there is no dearth of orders. There are orders. Okay. It depends on what we can produce.
So as of now, you're saying exports will grow by 35%. We got that. Right. Earlier you were guiding for a higher number. You're being conservative. Overall, though, the growth will be 16-17%. So as a consolidated entity, it won't hurt you too much. What about margins? Margins, I think you were guiding for around 11%. It's a little bit shy of that. What's the guidance for a year on an average?
According to our calculation, the EBITDA, what we the way we calculate it is 11.28%. So the EBITDA is grown by around 0.8% compared to last year, same period. And maybe if you remove the exchange fluctuation and interest income, you may say that it is 10.5%. But the way we calculate it, it has grown, and we hope to grow it by a little bit more in the coming months.
So, I mean, okay. So, by around 11% for 25 is what you'd said. And I'm assuming that you stick to that, right?
Yes.
Okay.
Yes.
You briefly alluded to how you have some capacity constraints still. So, could you give us an idea on Sanand and some of the other expansions which were underway?
Yeah, our new expansion at Pathredi is likely to be commissioned in the Q2 of this year. Earlier, it was projected to be commissioned in Q1, but there is some delay by around 2 months. So we expect it to commission it by August or September this year. And so far as Sanand is concerned, we expect to commission first phase of the project by end of FY25.
Okay, all right. What about the debtor days, sir? Are you on track to see some reduction in the number of days? I think you were guiding for 10 to 15 days reduction in this year. On track?
Yeah, it is on track. The data have gone down. I don't have the exact number at the moment with me.
Okay. All right. We will leave it at that. All the best for the quarters to come, and hopefully you will achieve all your targets. That's KEI Industries. Quite optimistic, actually, and the stock as well is up almost about 2.5%. Just wanted to point out a few things about the market. One is that the market may be quiet, but there is plenty of action in the broader market, so don't lose sight of that. And plenty of stocks are sitting at fresh 52-week highs. So whether it's something like an IEX, BPCL, Jindal Saw, NTPC, Power Grid, all at fresh 52-week highs right now. Questcorp also is at a fresh 52-week high. So don't be fooled by the flatline move of the market. Individual stocks are doing their bit at the moment. CAMS, by the way, is one stock which has had a dream run this year. CAMS is the one I'm talking about. It's at 4,400 now. It's a fresh high there, and the stock is up 66% in 2024. So this is that kind of a market, I guess. But Pankaj Tibrewal is joining in. He is the founder and CIO of Ikigai Asset Manager. Pankaj, hi, good morning, and good to see you in on the show. The market has been very, very strong and has rewarded a lot of long-term retail investors. But what now? Most of the triggers are behind us, including triggers like, the union budget. Now, of course, there's expectations of rate cuts as well from the Fed. But going forward, how are you approaching the markets?
Good morning, Sonia. If you look at one of the primary reasons of this kind of strength we are seeing in the market is the fundamental earnings growth for the last 2 years, which we saw from FY22 to FY24. However, we believe that the first quarter has started on a very muted note. If you look at the 175 companies out of the NSE 500 companies, which have declared results till day before yesterday, the numbers are not very encouraging. If you look at the headline numbers, it's 6% earnings growth. But if you bifurcate into two parts, 58 companies, which are BFSI companies, they have delivered 27% earnings growth. But the 118 companies, which are non-BFSI companies, which is largely the broader market, they have delivered negative 8% earnings growth. So the idea is that the earnings growth has started to slow down. And our sense is this year it will be a 10 to 12% earnings growth for the broader market as a whole. And that, I think, should weigh on the overall market movement at some point of time. Second, if you look at Nifty also, 30 companies in Nifty have reported, and it's a flattish earnings growth. And if you again bifurcate between BFSI and non-BFSI have seen negative earnings growth. It's BFSI which is pulling up the earnings growth. So we believe that earnings momentum is slowing down. Margin lever, which was the main contribution of earnings growth last year, is receding. And hence we need to be very careful in the markets because there are certain pockets which are full of exuberance. For example, look at the railways and defense as a total market cap. It's now about 18 lakh crores. FY19, this total combination was 1.2 lakh crores, which is about 67% CAGR in market cap. But the profits have grown at 21% CAGR. So certain times in markets, you need to be careful of what not to do. And I think the elimination method works the best. This is the time in the market where you need to be absolutely clear what to avoid and what not to invest in. And I think if you can navigate this over the next 12 to 18 months, I think you should be okay. So I think we need to be careful in the markets in terms of stock picking.
No, that's very well put. What not to do is also a decision, right? And what to do, of course, is one. Pankaj, hi, morning. Always great to speak with you. So I think we get a sense of what not to do from you, right? I mean, you cited that stunning statistics, almost 70% CAGR in market cap of those two sectors from 19 onwards. But, money is still coming in and you being handed money from investors at Ikigai. So you got to put that to work as well. So let's talk about what can one do and, what should one do, Pankaj? Sectors and themes, etc. You're still comfortable with?
Prashant, I think one sector which is seeing reversion of margins is consumer durables. I think we saw a very strong summer and the ground feedback is that there is decent demand uptick across the board, whether it be smaller appliances or larger appliances. And the industry profitability pool is at a decadal low. So we believe that this year you could see margin reversion in certain consumer segments, whether it be discretionary, durables, or in terms of FMCG as well. The second is pharma. I think we continue to remain positive on the US generic space plus the domestic space. And there are certain pockets like CDMOs. In our view, that's probably a next 2 to 3 year story. And if the law gets passed in US, which restricts the imports from China on CDMO and others, I think Indian players have a very long runway of growth. So that's another segment which is looking good. Financials, I think, is reasonably valued, especially the private sector banks. And I think given their franchise and the long runway for growth, I think after a long time, you are getting few of the good franchises at very reasonable valuations. Fourth, I think auto ancillaries is another very interesting space, because what we are seeing in certain auto ancillaries is the texture of the company is changing for good. All this while they were dependent on auto sectors, whether it be two-wheeler, four-wheelers, or commercial vehicles. But certain auto and companies have also pivoted themselves to industrials. And in many cases, 30 to 50% of their incremental revenue is coming from industrial sector, which is seeing decent growth, and they have a right to win. So I think auto ancillary selectively also is looking good. And last but not the least, metal prices are at intra-year low. We believe that there could be a case as a contra call to look at metals as a sector. I believe that the prices across the board, whether it be ferrous and non-ferrous, have fallen across, and valuations are reasonable if you look at some of the companies from a capacity perspective. So these will be the few sectors, I think, where one can deploy incremental capital. But again, I repeat, it will be a stock pickers market. I believe the breadth of the market has started to narrow down. Only 40 to 45% of mid and small cap companies have been able to outperform the index, which is the first sign that market has started to differentiate between companies. So I believe that this next 12 months, be careful in terms of picking up stocks, and it's a stock pickers market.
Okay, all right. Hi, Pankaj. Good morning. Always good to see you, Ben. So it looks like the easy money has been made. Now you'll have to work a little bit harder or a lot more harder from here on to make some money, going by earnings, going by the, the entire investment scenario. Let's talk about, you briefly spoke about metals. Let's talk about cement. What are you making of this entire consolidation that we are seeing? In the near term, there could be pain on prices, which will reflect on profitability as well. But it seems the street is more focused on maybe 4 or 5 big players in the times to come, and the large will get larger, which will be a longer term positive. Your take?
Yeah, Nigel, absolutely you're right. This is a consolidation phase, and our sense is that the top 5-6 players will command more than 60% market share in India. And that's happening region-wise. If you look at South, the latest move by Ultratech is a welcoming step, and there's a significant consolidation which is happening in South as well. And over the last decade or so, we have seen 200 million tons of cement capacity change hands, which is worth about $25 to $30 billion. And I think more is on the anvil, the way things are moving around. And we believe that once the consolidation phase is behind us, the cement prices have not really reacted. If you look at the CAGR of cement prices, it's about 1 to 2% over the last decade, which is lower than the inflation rate. So I think there's a long runway. Once the consolidation phase gets over the next 1 or 2 years, I think you will see cement prices inching up. So companies which are very strong on cost curve, companies which have a good brand where they command premium, and also the balance sheet is in good shape, I think will be the companies to bet on. So if you take a 3 to 5 year view, cement is in a very sweet spot. And we believe that the demand growth can outpace supply growth over a period of time. And don't forget, limestone is not in abundance. There are only few pockets in India where limestone is available, and that will become bottleneck from an incremental supply perspective. So keep that in mind. And I think if one is patient enough, this sector can be rewarding over a 3-5 year period.
The other space I wanted to talk to you about, Pankaj, was autos, because, you know, come Friday, we have the Ola Electric IPO, and this one is gaining a lot of traction purely because it's the first pure play electric two-wheeler, you know, manufacturer that will be listing on the exchanges. But we do know that Ola has its own fair share of problems, whether it's higher losses, higher attrition, all of that, right? So in that space, the electric two-wheeler space, do you think it makes more sense to stick to the listed players despite them having lower market share, or is this an IPO that you would be interested in?
So rather than commenting on stock specific, I think let's look at the trend. I think over the last 5-6 years, EV globally has been a talking point. We have seen changes, and the changes will happen over a period of time as you move and pivot from fossil fuels to EVs. But last 12 months to 18 months, if you look at, there's been a significant change. Toyota is one of the best performing auto stocks, and they have never pivoted themselves to EV. They never believed in that thought. And they've always said that hybrid is the way to go. On the other hand, some of the EV makers across China and US are having troubles when you look at their stock prices and in terms of volume growth. So clearly the change is there on the canvas, but the change may not be as fast as the markets were expecting a couple of years back. So I think ICE is there to stay. And we believe that there are certain companies which have significant, market share in this space. And people were giving a negative terminal value to them, say a couple of years back, which has changed now. And I think both will coexist as we move ahead. And the change may not be as fast as what the markets were expecting. So I believe that having a right combination in the portfolio of both the ICE engine companies as well as the EV players will be the right strategy rather than either or all.
Pankaj, just a few points. So consumer durables, so buy the brand or buy one of these sort of EMS companies? That is one. Auto ancillaries, are we talking about sort of bearing companies? I mean, if you could give us some sense without actually not as stock recommendations. And metals, what exactly? Are we talking about steel in particular that you like?
So Prashant, I think on the durable side, we believe the companies with strong brands can do well. And we are seeing in certain cases market share wins. And my broader thesis is that the industry profitability is at a decadal low. And there could be reversion in margins as competitive intensity starts to come down in certain pockets, which we are starting to see. Second point is on the EMS space, you need to be very careful that many companies are not generating operating cash. So they are trading between 20 to 30,000 crore market cap. But when you look at the cumulative operating cash flow of the last 4 to 5 years, it's flat to negative. And I get very worried when I see companies with only earnings growth but no cash flow. Finally, top line is vanity, bottom line is sanity, and cash in bank is reality. And if companies without cash flow and only growth are recipe for disaster. So one need to be careful on those companies which are not generating cash flows on EMS space because these are wafer thin margin businesses. Second, on your point on metals. On metals, I think certain companies, both on steel and non-ferrous, probably are looking good if you take a 2-3 year perspective. And we are seeing that incremental return on capital on some of these names are in double digits, which is very, very encouraging because they will like to sweat the assets on the capex done over the last couple of years. And steel and non-ferrous, especially aluminum, looks to be in a decent space.
And auto ancillaries, if you can go one step down.
And auto ancillaries, in terms of auto ancillaries, we believe that, as I said, there are certain companies which are changing in terms of business competition. We are very excited about those few companies where industrial is also becoming an important component apart from autos. So there are certain companies which are catering to aerospace, defense, which are catering to wind, which are catering to renewables. And I think once you start moving into that, you have a balanced portfolio on both the autos as well as non-autos. And some of them are also pivoting themselves to engine agnostic technologies. So whether it be ICE or EV, which time will only suggest which one is the winner, but they will be riding on both. So I think that terminal value concept or the terminal value question may not come true for a few of them. So we are also looking at few of the auto names on that side.
And sort of just share your thinking on this entire power space as well, Pankaj, if you will. NTPC had that analyst meet yesterday. Market's very excited. There's that renewable play in it, and there's, of course, a runway for thermal expansion as well. So just your thoughts.
Prashant, I think power is a decadal story, not only in India, but globally. Look at few of the data points. For 20 years, power demand in US was flat. And suddenly over the last few years, you have seen a very sharp increase. Why? Because for everything you need incrementally, you need electricity. Whether it be Bitcoin, whether it be electric vehicles or electric anything onto EV side, or whether it be data centers. And what used to happen earlier globally was the large amount of power used to get consumed when a big steel plant used to come, when a big aluminum plant used to come, which used to take 3-5 years, and you could have planned your supply accordingly on power. But now data centers take 8 to 12 months, and so many other consumption of power takes very little time. So you have to match the supply according to the demand. And renewables are doing that. But the problem is on transmission. Globally, the grid is, choco-blocked, and especially in India, also if you look at the day power rates in northern India is higher. The day power rates across and on average in India is 2 rupees, but in northern India is higher. What does it suggest? That the transmission is not happening. And I think a large part of investment globally and in India over a period of time has to move into transmission to make sure that electricity travels across the board. And in my view, over the next 5-10 years, power as a value chain can throw a lot of winners. We need to be careful because a lot of them are pricing and they are pricing and valuation. That's the only challenge. But if you take a macro construct, I think globally there's a demand which is increasing in power and supply is not catching pace. And the bigger issue is transmission. I think the grid is choco-blocked across and we need significant incremental investments. That's why I was not very surprised when Power Grid at their analyst meet yesterday upgraded the guidance on capex from 15,000 crores to 18,000 crores. And I think India needs significant amount of investment on the transmission side.
Okay, all right. Macro opportunities there, definitely. But what about stock-specific opportunity and how much is in the price? That's always the question. Pankaj, great to have you with us here. Thank you very much for your time. Appreciate it. I just want to highlight just one stock. Philips Carbon Black is up 8% now. It's a Sanjeev Goenka Group company. We should actually put that out as an alert. We had some very aggressive targets being put out by Mr. Goenka yesterday, and we'll play out snippets of that piece today as well. So 323 on PCBL at this point. And CESC is the other one, which is up 5%. Stocks at about 175 at this point. Lots happening. The Nifty is also moved up. It's not flat or down anymore. It's up 45 points. That's PCBL, Philips Carbon Black. Look at the volumes as well. 7 million shares. We don't see that much on that one at all, but it is trading with heavy volumes. We'll take a break. We're back. We'll connect with the management of Maharashtra Seamless, which reported numbers as well. Stay tuned. That's coming up.
Welcome back. Well, let's focus on one of the stocks that are getting clunked back today. That's Maharashtra Seamless. The numbers are quite disappointing. But to understand what went on, Mr. Saket Jindal, the MD of the company, joins us on the show. Hi, Mr. Jindal. Good morning and good to see you. Well, the street is clearly disappointed on the margins front. It appears that higher raw material cost has hit you and maybe some inventory loss as well. Could you tell us from this 11% margin, do you see margins recover on a blended basis? And also on an EBITDA per ton basis, the seamless vertical, well, you have the EBITDA per ton coming sub 10,000 rupees, and even some pressures what we saw in the ERW business. So guidance on both these two on the EBITDA per ton.
Right. So this quarter, there was some dip in the margins because of some 5% dip in sales, and largely due to raw material, and we had bought some higher value in March. So on an accounting basis, on FIFO basis, the accounting is showing in the increased liquid inventory some fluctuation, which is largely causing the difference in the margin. And there's been some other expenses which are booked in this quarter, which was pertaining to earlier and made provision earlier. And now we have booked those expenses pertaining to earlier quarter. So this is the three reasons why there is a dip in the EBITDA. And we are hopeful that in the next quarter, definitely we will post as per earlier quarters, because our production has been consistent, and both in seamless and ERW, if you notice, our production has been consistent, not much fluctuation, maybe 4-5% maximum.
Okay.
So production is consistent, and the accounting factor has led, and raw material and all, to the dip. And we expect to post again in the next quarter as per earlier, and maintain the growth rate.
Okay, all right. So margins go back to that 19-20% that you delivered earlier. Is that correct?
Yeah, hopefully, because there is also one more factor, that Chinese material has also started coming into the country. So in some sectors, not all sectors, like so that has led to more competition.
Okay.
And,
which sectors, sir? Which sectors are you seeing imports coming?
Mainly in the boiler and engineering sector.
Okay.
So we are presenting with the government to enhance the anti-dumping duties, and also to put better quality standards, so that substandard material doesn't get imported into the country.
Okay. So what is your representation? How much you want them to increase the ADD to protect you?
That is still workable, because currently there's a floor price of $960 or so. So that floor price is not enough to contain the imports, and there is some unofficial imports also. So we want a better way of checking this through custom duties, which are more relevant, or which are more effective. So we are trying to work out the best solution.
Okay, you know, when you joined us last time, you told us the base case for seamless will be around 15,000 rupees per ton. And on ERW, you were guiding for a wide range of 6,000 to 11,000 rupees. What is the revised number? Because this time around, it's come in sub that 15,000 rupees, the seamless business. So you think you get back to those numbers? Seamless goes back to 15,000 and ERW will be in that vicinity of around 6,000-7,000?
Yeah, that's a reasonable figure, and we want to come back to that figure. And I believe that's a reasonable figure.
Okay, you know, what's supporting you, sir, is your cash in books. And in the past, there have been, you have given some hefty dividends at times. Now, since the stock price has come off, my director pulls up the chart, the stock price had gone to 1,000 rupees and it's corrected from there. So two-part question. One is, at times you have come and you have bought from the open market. Do you think you'll be looking to do the same at current prices? And point number two, how do you want to deploy this 2,000 crores of cash?
Right. So some consolidation in holding can happen. That is part of our strategy. And second is the extra cash which you're mentioning. We will definitely deploy them. And we have two projects in hand. One is a premium connection project for high pressure applications in the oil and gas sector, in ONGC and all. And the second is cold drawn project, which is again a value-added product for heat exchangers and other boiler applications, which also uses our mother pipe, the hot fill pipe, and the hot finish pipe is used to make the cold drawn.
No, so I didn't get that. the consolidation of holding will be you could be looking at buying some shares from the open market? Is that what you're hinting at?
Yeah, some creeping acquisition gradually,
okay.
Not so much significant.
Got it. We have your order book, sir. That's roughly around 1,800 crores or thereabouts in terms of your order book. How much of it is exports?
Yeah, so exports have dipped in the last 1 year. Earlier, it used to be 25-30%. And currently, it's dipped to, I believe, less than 10%. So the reason is, again, the international geopolitics, where, in US and Canada, there is more competition from other countries. And even Ukraine and Southeast countries have started exporting to US and Canada because of the geopolitics and the difference in demand supply. So it is stiff competition, and we expect it to ease out in the future.
Okay, all right. Final question. Volumes last year on the seamless side, you did around 400,000. On the ERW, you did around 100,000. So for this year, you're saying volumes will be more or less constant or flattish. So no big growth in both these two numbers for this year. The growth comes in FY26. Is that correct?
In the production volume?
Yes.
Right. So we expect to maintain consistency this year.
Okay, all right. Mr. Jindal, thanks a lot for joining in. So we look forward to this guidance that you've given us. Flattish volumes, but you expect margins to go back towards that 19 to 20% and maybe some kind of support on the price, given that you have cash in the books, as well as you could consolidate your holding as well.
Okay, that's Maharashtra Seamless. By the way, the market is, it's not doing too much, but there are many stocks that are looking pretty good at this point in time. Let's do one thing. Let's talk about Kansai Nerolac Paints. Q1 was a muted quarter for them on expected external weakness. Their decorative business was also impacted by elections as well as the heat wave. Anuj Jain, who is the managing director of Kansai Nerolac Paints, joins us now. Anuj, thanks a lot for joining in. You know, it is this muted performance that is kind of worrying, but that's been the case with the entire industry. So your company is no different. I wanted to understand a little bit about what the volume growth was in both the decorative and the automotive business in the quarter gone by, and what are the targets for the full year?
So overall, if you see, the volume growth was mid-single digit. Decorative, you can say low single digit. And I think the growth was driven by auto in the first quarter. And as you rightly said, in decorative, it was muted. The non-auto also, it was muted. But I think going forward, because the monsoons are good, and the first quarter, I think it is clearly understood that why the demand was low. And we have seen some pickup in the month of June. And therefore, we foresee that the demand in decorative will improve gradually. And non-auto, in fact, we have seen the good uptick in the month of June. And based on the continued thrust on the infrastructure and the order pipeline, what we see, we feel that it is going to be a strong growth in the coming quarters.
Okay, strong growth in the coming quarters. Got it. So, any price hikes, since growth is looking good, do you think you can take more price hikes, you can pass on more price hikes to the consumer? If yes, what has the quantum been so far and how much do you plan to do further?
We have seen some 1.5 to 2% of inflation, which already happened. And to mitigate that, 2 price increases have already been, so one is already implemented and one is in pipeline. So overall, between 1.5 to 2% of price increase is what we are going for.
So hi, morning. So you're saying that both are done now in terms of price increases? One will go into effect?
One is done and the other will come into effect in the coming month.
Okay, got it. Now, could you tell us, so both on the decorative side, non-auto and auto, what kind of volume growth are we to expect? I remember you telling us on the auto side, you'd much rather look at the value growth, decorative volume growth. So could you give us where you're at and what you see for the full year, FY25?
So if you remember last time also I discussed that in automotive, we are expecting a production growth of 6 to 7%, and therefore the paint growth could be similar to that. In decorative for the entire year, there could be some kind of up and down during the quarters, but we still feel that higher single-digit volume growth is definitely possible, during the year.
Okay, all right. Hi, sir. Good morning and good to see you in. If you could tell us about your premium product business as well. You've exited some low-margin businesses. What is the mix currently, premium versus economy, and how do you see it panning out?
So one of part of our strategy was to increase the saliency of the premium item, and that is applicable in decorative also. That is applicable in some segments of the industrial segment also. And in that regard, last 1.5 year, we have taken a lot of initiative, and it is doing well. So the premium saliency, even in the first quarter, in decorative has gone up, and even in the other parts of the non-auto industrial business, it has gone up, and that is something which you can see is reflecting in the expansion of our gross margins.
Okay, but you want to put a percent to it?
In decorative, it is closer to 30%, the premium saliency now.
Okay, in decorative, 30% is coming in from the premium part of it. Got it. Also, a word on competition. Birla Opus, they have been quite competitive in their pricing, but now you have price hikes that are coming about. So how do you see the competitive landscape shape up?
I think this market is quite big, and industry growth consistently it is growing. I said earlier also that per capita consumption of paint is lower. 25% is coming from the informal sector. So I think, and also this, especially in the decorative, the industry is more dependent on the influencer. So with the more competition coming in, I see a positive that it will spur a better growth of the industry over a period of time. Because when new good people participate in the market, more communication, more visibility. So this helps in terms of increasing the penetration. We have seen in some other categories also. Also, this effort will result into bringing consumer more closer to the category. So that also will help. So overall, I feel that over a period of time, it's a positive impact in the industry because market growth through per capita or the informal to formal will go up, and more involvement of the consumer, and that will be good for the entire category.
Okay. So when you talk about the category growth, right, overall, in the slightly medium to longer term, now that there is broadening of the category, more players are coming in, more, distribution is picking up, more capex is being put on board. What kind of sort of sustainable growth do you see for the industry over the next 1 to 2 years?
I can comment, if you see last 5-10 years, industry has been growing in double digit, and I see no reason that why over a period of 3-5 years, why the industry will not grow at the rate of same, double digit growth. And in that growth, if new players are there and maybe 2%, 3%, 5% of the growth gets allocated to the new player, it's fine. I think over a period of time, industry will get reset. But I do see advantage to the industry in terms of 1 or 2% additional growth coming in because of the new competition and therefore the innovations, and so that is how I see it.
What about the adhesives business, sir? How much does it contribute to your total revenues? And I think you had given a target of 5% of total sales. You could correct me on that number, but if you could tell me by when.
So adhesive is a part of our new business. In new businesses, we have construction chemical, waterproofing, adhesive, and in totality, now this new business is contributing approximately 10% to our total business. Adhesive is a separate subsidiary, and there we have industrial adhesives and the consumer adhesives also. But it's a part of a total new business which contribute about 10% to us.
Okay, we will end this discussion on that note. Thanks a lot for joining in. That's Kansai Nerolac with their view on the business and the way forward. By the way, the market is very quiet, so let's take a quick break. On the other side of the break, we have Puneet Lalbhai, the Vice Chairman of Arvind, to discuss their Q1 earnings performance. Stay tuned. Welcome back. Let's focus on Arvind Limited now. Their Q1 performance saw a hit because of the workers' strike that took place. The strike affected their main business, including the woven denim segment. Management says that domestic demand is likely to improve tangibly in Q2 given festive season and wedding buying. We have Puneet Lalbhai, the Vice Chairman of Arvind, who joins us now to talk about that. Puneet, thanks a lot for joining in. Before we talk about your overall business, I wanted one word on this workers' unrest. What kind of impact has it had on your business? I'm sure it's caused a lot of inconvenience, but if you can share some numbers with us on the kind of damage it would have done.
Sure. So I think it would have taken away about 200 crores of revenue and about 60 crores odd of EBITDA.
Okay, so the impact is 200 crores on revenues and 60 crores on EBITDA, right? So, I mean, what kind of clarity can you give us in terms of what revenue growth could look like going forward? What are the trends like currently in terms of demand and, you know, any kind of targets that you're looking at?
So demand for our business is quite robust. Our export garment orders are looking quite full, the order books. And the domestic demand, as you mentioned earlier, is also picking up. And we have excellent demand on fabric exports as well. Advanced materials continues to do well. So we are still feeling as if, you know, we'll see robust growth in the next 3 quarters, and we should be back on plan by the end of the year.
Puneet, hi, morning. So strong double-digit growth for 25?
Well, it will be double-digit. Early double digits is what happened.
Okay. And what about margins, Puneet? Because I think there was a freight impact as well in this quarter, and that perhaps will continue to show up in the coming quarters as well?
So there will be some pluses and minuses, but on the whole, we worked very hard on locking our margin for the last couple of years. And I think we should now start stabilizing at this level before we start with.
Okay, all right. Hi, Puneet. Good morning and good to see you in. This is Nigel on this side. Margins in the past quarter were around 8.2%. But since you'll have operating leverage that will play out, should we work with the number of closer to around 10% for the year?
Yes, so we've been around that 10% for the whole of last year.
Okay.
Study the numbers. This quarter, of course, is very difficult to study the margins and conclude anything because of the disruption that we saw due to the strike. But in that 10% to 11% area is where we are hoping to land the margins.
Okay, all right. You know, the positive, I think, in the past quarter was garments. You know, you had done, I think, close to around 10 million pieces. And I think you were guiding for a number of more than 35 to 40 million. What is the volume targets you're looking at in garments as well as denim and woven?
So we are keeping all our volume targets on garments exactly the same. And both on wovens and denims, we will be operating at close to 100% capacity in the next 3 quarters.
Okay, all right. You guided for revenue growth in double digits, Puneet. Low double digits. What's the breakup? I mean, AMD will grow how much and your textiles will grow by how much?
AMD will grow closer to 20%, hopefully cross 20%. And textiles will be approaching double digits, so 9 to 10%. So the overall margin will sort of spill into the low double digits.
Okay, all right. Also, you have laid out a capex plan. I think it is around 450 crores. What is the asset turn that we'll see on this? And the capex plan, any change there from that 450 crores?
So if you look at the capex plan, there are 3 components to it. About 40% will go towards the advanced materials division. About 35% should go towards garmenting. Both of these businesses have very good asset turns. So they would average between 3 and 4 times capex. And the rest of the 1/3 of the investment will go towards core textiles, where we'll be doing innovation investments, debottlenecking capacity, and of course, doing a lot of maintenance capex.
So on a whole, this 450 crores could result in revenues of around 13 to 1,500 crores?
That's fairly accurate. Of course, it will take a couple of years to achieve 100% utilization of this capex. So it will come in a staggered way, and I think in year 3 we should see, you know, that full turnover manifesting itself. So it will be this sort of a rolling thing. Next year there will be another capex plan. So yes, on an average, you can say 3 times the investment.
Puneet, just one last question from my side. On the AMD side, where you said you're expecting 20% growth, that's advanced materials. Which are the segments which are seeing the fastest growth? And I think you're calling for 2,000 crores in revenues in the next 2 years. Is that correct?
Yes, that is correct. We should cross 2,000 crores year after next quite comfortably at the current run rate. The division is broken up into three major components. There is a human protection business, there is an industrial fabrics business, and then there is the composites business. And all three are growing at around that 20%.
Okay. All right, Puneet, we'll leave it at that. Thanks a lot for joining in. That is the Vice Chairman of Arvind. Let's slip into a quick break. Up next, we'll be joined by Sumant Katpalia, the MD and CEO of IndusInd Bank, to discuss the company's performance for the quarter gone by. Stay tuned.
Welcome back. We continue with our earnings focus. This time it's IndusInd Bank. The first quarter FY25 was a bit below street estimates. Net interest margin came in at a 7-quarter low, just marginally lower than previous quarter. Asset quality also saw some trouble, but the business momentum was healthy, 15% growth in deposits and almost that much in advances. Sumant Katpalia, Managing Director and CEO of IndusInd Bank, is with us. Sumant, good morning and thank you very much for joining us. Actually, the banking sector itself has been under a bit of pressure, but I'm looking at the analyst reports written about you. ROE, ROA are both lower than the previous quarter, as was the net interest margin. According to you, what was the problem?
So, good morning and thank you for inviting me. I think it was a very stable quarter. And yeah, of course, the quarter one is generally a weaker quarter and it got also impacted by some external factors. But I continue to believe if you look at, our two domains, which is microfinance as well as vehicle finance, and specifically in the rural belt, we did have a slowdown to a large extent, and they are high-yielding portfolios of ours. And we did not want to push it at this point of time also. So I think if you look at the revenue growth was a tad lower, but I think our NIMs were maintained. Our fee, because of the processing fee going down, I think it got impacted. And if you look at our expense, actually for the first time our expenses have come under control in the last 4 quarters, and we were 2% quarter-on-quarter growth. So I continue to believe once our acquisition ramps up, I think, and which is already happening, I think you will start seeing us getting back into the ROA margins which we've set to ourselves, which is 1.8 to 2.2%.
Okay. By when do you think you can get over there? I mean, you're not a big distance from there, but when do you see 1.8? When do you see 2%?
So I think quarter 3 onwards, you start seeing 1.8 coming back. And I think by quarter 4, we should be between 1.9 and 2.
Okay. To some extent, God is against the banks. And by God, I mean RBI. The LCR rules are clearly going to mean that you have to put aside a little more money into government bonds, which obviously are not going to fetch you more than 6-7%. So how much do you think your costs may go up? What is your LDR now anyway?
122%. LDR is about 88%, 87.5.
87, okay, sorry. LDR is 87.
LCR is about 122.
Okay, so will you want to bring it to, will you want to keep it at 122, or will you now be okay with 110?
So our board is, we've got an internal guideline that we should be 110% and above, but we've always kept it at 115% and above for ourselves. So I think while the LCR guidelines are being finalized, I think there is a single-digit impact to us which we've calculated, and we should be able to, fine-tune our liability strategy to take care of that.
Okay. Regardless, there will be a war for term deposits because, there is an obvious attraction there, and deposits have been growing far slower than advances. So, therefore, how will NIMs pan out in the current and next quarter? When do you see it perhaps inching up?
So we've always said that our NIMs are range bound between 4.2 and 4.3. You should have seen it in the last 8 quarters. We are very range bound between 4.2 and 4.3. And I think in higher interest rates, we will be at 4.2, 4.3. In lower interest rates, even with the LCR, we should be at 4.2 to 4.3.
Yeah, of course, you're a distance from 4.2 anyway. And as you point out, you have an LCR buffer. The slippage is bit now. You speak about, you said that MFI and some rural pockets did see stress. Is this likely to abate? Because, I mean, while I agree with you that agri loans are always a first quarter thingy, MFI has been a matter of concern for the last 6 months, even with NBFCs. So how do you see the overall stress panning out?
So I think, Lata, what is more important in an MFI business is the approach which you take towards credit. Growth is not the only criteria you should be looking at. You should be able to identify districts and states where you think over-leveraging or some external pressures are building up. So, for example, there were states like Odisha or Punjab, for example, I'm saying it. We actually started slowing down our businesses 6 months before that. So, if you look at, we've always said our MFI portfolio will have a gross NP of 3.5% and 2.5% credit cost. We've been range bound in that. So even if you see this quarter flow, it's 330 crores flow. So it's not that we've increased our flow dramatically on MFI, contrary to what the market is saying. So we are range bound between 330 to 350 crores, which is about 3.5%, and our credit cost is between 2.5% to 3%, and we've been range bound in that.
No, fair point. I mean, all businesses, all banks have some high risk, high return businesses and low risk, low return businesses. I take your point on that. I think the market's getting disconcerted because slippages did go up. The slippage ratio has gone up. So, I mean, what is the guidance on that, therefore?
So, we don't give guidance on slippages because we have some cyclical portfolios. For example, first quarter is a very weak quarter on the vehicle finance business. We had 680 crores of flow against the 475 crores of flow. So if you look at our flow, the 10% increase, 90% of that has happened in the vehicle finance business.
Okay.
And I think we don't give guidance, but we've given guidance on the credit cost, which is 110 to 130. And if you see us, we've never busted 110 to 130 basis points of credit cost.
What is your cost of funds, Sumant, and how much might it inch up in this phase of war for deposits?
So I think from last quarter to this quarter, we had a 5 basis point increase in cost of deposits and 3 basis points increase in cost of funds. Overall, our cost of deposits over the last 7 quarters has inched up by about 130 basis points.
Do you think banks in general
because
are
more and more is moving to term deposits?
Okay. Yeah, absolutely. Do you think banks will rely more on
to term deposits?
I'm sorry, there is a voice lag. Do you see banks like yourselves going more into CDs now because the bond market rates are dipping for other reasons, bond index, LCR demand, etc.?
I think I've said that our dependency on the CD market should not be more than 3 to 5%. We've always kept that. If you look at today also, we are at 2.8%. I continuously feel that you should not take shortcuts in this. We are low on retail. I think we have to granularize the portfolio. Our dependency on borrowings as well as CD markets will be low. But in the deposits, we may play for some time the bulk deposit game.
Sumant, what is the likely impact of the project finance provisioning that is going to come in sooner or later?
So, Lata, we've looked at our portfolio, and if you look at the composition of our portfolio, the impact will come more in the real estate side for us. I think it's a couple of hundreds of crores over a period of time. So I think, and we will do some pricing adjustments once the regulations are clear. So it's not such a big impact because we've not focused on project finance so much. We have some real estate portfolio, 5% of our book is in real estate. So that's the only impact.
Okay. Now to come to capital raising, markets in a kind zone, with Nifty nudging 25,000. Will you all want to use the opportunity to raise money?
We've just assessed our capital needs. You've seen the results. It's 16.15 CET1 and overall capital adequacy ratio of 17.5. I really don't think there is a need for us to raise capital. If we are going at 18 to 22%, our internal accrual should be sufficient to take care of that, as long as we are managing our risk-weight assets. We will assess it in another 6 months now, and we will see whether we want to raise capital. As of now, we don't have a need to raise capital.
No, there's this strange thing about capital, isn't it? When you don't want it, the market is very kind. But sometimes when the market is unkind, you need the money. And that's why people normally pick it up when it's available. Anyway, we will know in 6 months. Just a final question. There is this constant chatter in the media about Reserve Bank giving permission to the Hinduja group to raise its stake to 26. Anything you can, clarify for us with certainty?
So I can't talk about the promoter entity, but I can only say they've asked us for the fit and proper, and that's where we've given our submission, whatever the Reserve Bank asked us. And I think it's between the promoter and the regulator. We've not heard anything from the regulator.
Okay, that's most useful. Thank you very much. Clarifies a lot of doubts. Sumant Katfalia, always a pleasure speaking with you. Thank you very much, and hope you have an eminently successful FY25 too. Okay, so that's the word. That's the word coming in from IndusInd. They are staying in a range, whether it is ROA or whether it is margins, within that 4.2, 4.3% band as far as margins are concerned, and credit costs under control, as they say. Guidance is 110 basis points. Well, markets still in absolutely flat terrain, except for the mid caps. But on that green note, we wrap up on Bazaar. Chartbusters coming up.